right. So I'll go ahead and get started now. So like I said, I'm Shannon Osborne. I am the Assistant Director for Financial Wellbeing in the Student Support and Advocacy Center here at George Mason. I recently started at Mason in January. I moved here from Colorado. And then, March happened and all of this, but we're basically really excited to start creating financial literacy here on the Mason campus and everything that's centered around financial well-being. So really, we wanted to create these Money Talk series as a way to start talking to the Mason community about all things financial. And so that means students, staff, faculty, alumni, Mason community in general. And we really wanted to start with this first one on student loan repayment. In addition to that too, so I will be presenting, but I do have a moderator, Clarissa, and I'll have her go ahead and introduce herself to you.
Hello, everyone. Thank you for attending. We really appreciate it. My name is Clarissa Meza. I am a graduate assistant for the Financial Wellbeing Program. I am going to be starting my second year in my master's program for public policy here at George Mason. I also graduated last year, 2019, with my bachelor's, for government and international politics. Again, thank you so much for being here.
So if you guys have any questions, you are off camera and off microphone. So there is a Q&A box down below. So as I'm doing the presentation, if a question comes to your mind that you're thinking of, just go ahead and type it in. Clarissa will read the questions back to me and make sure that we're getting all of your questions answered, and all of those things. In addition to it too, I did read through your questions that you submitted ahead of time. So hopefully I've incorporated most of the questions in the presentation. If not, Clarissa will remind me too if I miss anything and all of that. So anyways, I will share my screen in PowerPoint and go ahead and get started. Okay, so Clarissa, can you see everything so I know that it's all working? Okay, so like I said, this is the first of the Money Talk series that we're going to do all through the year. And this one is on student loan repayment. And I am Shannon Osborne, and Assistant Director for Financial Wellbeing in the Student Support and Advocacy Center. We do officially have an email address for the Financial Wellbeing team. It is fwb@gmu.edu. So you definitely can email there if you want to meet afterwards to talk about any student loan repayment questions you have for your situation, or if you have any general financial literacy questions or want to schedule any events in the future as well too. Okay, so this presentation is primarily going to talk about direct loans because that is what a majority of students have, are direct loans, and go into repayment with those. However, there are other types of loans as well that students might have, and that would be things like the Federal Perkins Loan. So the Federal Perkins Loan program, it ended actually September 30th, 2017. So most of you might not have any more Federal Perkins loans, but you might still if you had some before then. Those do carry a 9-month grace period. So when you graduate, or if you leave school or fall below half time, you would fall into that grace period of 9 months. They do not accrue interest, so they are subsidy loans, so they would not accrue interest during the grace period also. And you wouldn't begin accruing any interest until after that 9-month grace period. The typical time to repay those loans are between 5 to 10 years. However, you really need to work with your servicer on those repayments, and the servicer depends on the school. So for George Mason, if you actually got a Perkins loan from George Mason a long time ago, ECSI is the servicer, and that's their information with their website and their phone number. However, every university does things differently. So you would want to contact the university where you got the Perkins loan from and find out who the servicer is. Some of them, it's their student accounts or their bursar office. Some of them use a third party like ECSI. It just all kind of depends. In addition to it too, if you don't know if you have a Perkins loan, we'll get into how you can view your direct loans, but a Perkins loan is a government loan, so you can view them the same way. It just works differently than a direct loan. Another type of loan you might have are called private loans. So private loans is really where you went and you borrowed a loan from a bank yourself and you sought it out yourself. So it doesn't come from the FAFSA. Those typical ones would be like Sallie Mae, Wells Fargo, Discover, College Ave. Those are some big names that you might have heard from before. The typical time to repay those loans are between 10 to 15 years. And those are paid directly to the lender. So a lender is somebody who lends you the loan, and the servicer is somebody you repay the loan to. So with private loans, the lender and the servicer is actually the same person. So, or sorry, the same company. So you would pay it back to Wells Fargo, who you borrowed the loan from. Many private student loans do require students to start paying while they're in school. However, some of them do defer until afterwards too. Some of them have a grace period, some of them do not. So I definitely tell people to read their loan disclosure statement on their private loans to figure out what the repayment terms are, because students often are confused about that and don't know that they actually chose the repayment plan option when they chose their interest rate on private loans. And so in addition to the two, you would definitely want to get a copy of your credit report. Just if you don't know if you have a private loan, you can get your credit report for free, or you can pull it through things like creditkarma.com. That's also for free. You can sign up for to see if you have any private loans. But either way, they most likely have been emailing you if you've been getting close to repayment so that you would know if you do. Okay, so next is before you begin repayment. So really, once students graduate, the first thing they say to me is, I don't even know where to begin. And that's totally fine. Everybody kind of feels that same way. So I really want to talk about studentloans.gov. So studentloans.gov is the hub for everything. So it's where you went before to do the master promissory note, the entrance counseling to get the loans. You might have applied for Graduate Plus loan or Parent Plus loan there, but it's not going anywhere. So it has a lot of repayment tool options that I'll kind of walk you through that you can use. You can use what's called a loan simulator, where you can budget how much your monthly repayment will be. In addition to it, too, you can learn about consolidation or loan consolidation and determine if that's a good option for you. And you can also get help through it for signing up for public service loan forgiveness. All of these I'll go through in this presentation too, but do know there's a lot of information at studentloans.gov. Here's a screenshot of if you log into your account at studentloans.gov using your FSA ID. You'll see a list of my checklist, preparing for in school, I'm in repayment, I'm a parent. But really on the right is what I'm talking about. There's a loan simulator, there's loan consolidation, and there's a public service loan forgiveness help tool. So I would say in all my years of working on student loan repayment, they have really revamped their website to make it very clear recently for helping people kind of navigate all of this stuff. So once you officially graduate, you need to figure out who your direct loan servicer is. So this direct loan servicer is who is going to service the loan for you when you begin repayment. So a direct loan is borrowed from the government or the U.S. Department of Education, and those are like the direct unsubsidized, direct subsidized, direct graduate plus loan. Those are all direct loans. However, the servicer works for the Department of Education and they service the loan. So you're not paying the school that physically processed your loan, and you're not paying the Department of Education directly, you're paying the servicer back. Um, where you can find your servicer is through studentloans.gov. So if you log in with your FSA ID, it should say on that front main page there that this is who your servicer is and give a bunch of view loan service details there. You can also contact your school's financial aid office. They would be able to identify who your loan servicer is. I also joke, but tell students you can check your spam email. And the reason I say that is because they most likely have been emailing you this entire time. They maybe have just sent you emails that said, you're in school, you don't have to do anything, but we're here to help you. Sometimes I like to send automatic happy birthday emails and those kind of things. So, they should be in your email box somewhere. Here's a list of some current loan servicers. So Cornerstone, Fed Loans, Granite State. If any of these are popping in your head to say, I feel like I've seen an email from Mohila before, but I didn't know who it was, I'm probably willing to bet that's who your loan servicer is. So if you logged into studentloans.gov, you would see that Mohila was it. Or if you contacted your financial aid office, they would let you know that that was who your loan servicer was. Okay. So loan consolidation. So once you officially have established who your servicer is and you're ready to get started, the next question people always say is, should I consolidate my loans? And my answer is maybe, maybe not. It really depends on your situation. It depends on what type of loan you have. So let's talk about what loan consolidation is. So loan consolidation allows for student loan borrowers with multiple student loans to combine all of their loans together that create one loan with a fixed interest rate. So basically, the fixed interest rate is based on the average of the interest rates of multiple loans combined, meaning if you have a 3% loan and a 6% loan and a 9% loan, it would combine all three together to give you an average interest rate, maybe of like 6%. So the 9% interest rate will come down, but the 3% interest rate would go up in interest. It would also give you one loan instead of multiple different loans. Sorry. Once consolidation has taken place, the loan borrower will only have that specific one single monthly payment to make payments on. Um, there are different types of loans that you might want to consolidate or you might not need to. So the first would be Family Federal Education Loan Programs, or FFEL. So if you were to pull up your information at studentloans.gov or anywhere that has all of your student loan information, it would show that you have maybe what's called a Stafford unsubsidized loan. You wouldn't see the word direct in front of it. These are loans from, I'd say, pre 2010, because that's when the program ended. So around 07, 08, 09. They were loans that used to be the Department of Education loans, and then they moved into the direct loan program after that. And so those don't qualify for things like public service loan forgiveness. You have to be in the direct loan program to qualify for that, which we'll go into. So students that have FFEL loans would want to consolidate those into direct loans to qualify for things like public service loan forgiveness. So if you've been working towards making payments towards public service loan forgiveness, you're definitely going to check to make sure you have the right type of loans. If you've heard in the media them talk about the fact that when we saw the first cohort forgiveness, public service loan forgiveness, a lot of people were shocked to see that they were in the wrong type of loans and they didn't understand how that happened. That's because they were in FFEL loans. And there was a big campaign back in 2010 to encourage borrowers to consolidate FFEL loans into direct loans. So many people didn't understand the reason behind that or understand why. And so there weren't a lot of people that did that. So the consolidation can still happen now. It's just your time towards public service loan forgiveness doesn't start until those FFEL loans go to direct loans. Next are private loans. So you cannot consolidate private loans into direct loans. So if you have a Sallie Mae uh, private loan, you can't consolidate it with your Nelnet direct loan, even though Sallie Mae and Nelnet are all different types of student loans. You can't consolidate them together. You can, however, consolidate direct loans into private loans, because sometimes Wells Fargo, for example, has that. However, as you see at that bottom bullet point, I do want people to make aware that consolidating direct loans to private loans could lose things like income-driven repayment plans that we'll talk about, public service loan forgiveness options. So you do lose a lot of protections if you consolidate direct loans into private loans. Next are Perkins loans. As I mentioned before, they are government loans. However, they're not direct loans, so they don't qualify for public service loan forgiveness. They do have their own forgiveness plan for working in a nonprofit, but you work that out with your servicer and kind of set that up on its own. But if you just want one monthly payment, you don't want to pay Perkins to ECSI, you don't want to pay direct loans to Nelnet, you just want to pay them together, you could consolidate them with a subsidized direct loan. It would still be a subsidy loan, and then you could just have everything be under direct loan. So some people do want to do that with their Perkins loans. If you only have direct loans, you don't have any other loans but direct unsub, sub, graduate plus loan, I often do not recommend that you consolidate your loans. Anytime you consolidate a loan, yes, you are getting an average interest rate, but you're also running your credit. So because you're physically applying for a new loan, I'm not really a fan of running my credit unless I'm actually going to benefit from it necessarily. So with direct loans, whether it's an unsub, a sub, a graduate plus loan, you're still making one monthly payment no matter how many loans you have. So if you have 10 different direct loans, you're still making that one monthly payment. So doing consolidation, if you only have direct loans, isn't going to change anything. It would just reduce your credit a little bit. But in the sense of everything, when it comes to the repayment, it's not necessarily the best option. So it really just kind of depends. But if you still have questions on, I don't know if I should consolidate, you definitely can reach out to us and we can kind of walk you through all your different options so you can make the best informed decision that you can. If you did want to consolidate your loans, you do that through studentloans.gov. Like I said, if you did want to consolidate private loans, that's done differently by applying with a lender. However, FFEL, Perkins, direct loans, those are all government loans, and the consolidation is done directly through that studentloans.gov website. Like I said, if you have any questions, feel free to type them in the Q&A. Sometimes this part of it kind of brings up any questions as well, too. Okay, so next, this is kind of the bread and butter, I would say, of the presentation. It's definitely a lot to read. We will be able to provide these PowerPoints to you afterwards, so do not feel like you have to write down every single point. We'll also have them up on our website as well, and we are I should have said this at the beginning. I entirely apologize. I wanted to let you guys know that Clarissa and I are definitely new to this, so bear with us as we kind of work through the kinks of everything. But we are recording this, and we're recording it because we want to have people who have advantage to watch this later. So I apologize for not saying that at the beginning. But basically, this part of the presentation is where I took all of the different payment plan options for any government, the subsidized, unsubsidized loans, and I put it into one kind of easy to read, quasi easy to read PowerPoint slide. So I'm going to start at the beginning. So the first one is what we call a standard repayment. So if you don't do anything at all, that bill's going to come and it's going to be based on a standard repayment, which is 10 years. So it says, how much do you pay every month to pay your loan off in 10 years? The principal plus the interest at the end of 10 years. It's a fixed payment. So no matter how much money you make, no matter how much debt you have, that's your same payment that you pay every month. So if you only have like $10,000 or less, then you might get that first bill in the 10-year standard payment and say, this is fine. I can pay this amount and it'll be totally fine. If you maybe have more than $100,000 of debt, you might get that first bill and say, there's no way that I can pay that much. So all of these other repayment plan options are basically offering relief to that standard repayment option. So next is a graduated repayment option. This payment increases every 2 years. It can be anywhere from 10 to 30 years for the repayment. You work that out with your servicer. But the idea is that when you first graduate, your first job out of college, you're getting paid the least that you would 10 years after you graduate. And the reason that is because you're doing entry level jobs. And then hopefully your hard work is recognized and you're being promoted and your salary is increasing. So over time, the payment will increase. I don't absolutely love that idea because it's hard to say, like, 4, 6 years from now, I know for sure I can pay that monthly amount. However, if you know in the beginning you can't pay that standard 10-year amount, then increasing every 2 years could definitely offer a good relief that first 2 years or even first 4 years until you have to increase. If you want to get on the graduate payment plan, you have to contact your servicer to set that up. Your servicer will do a good job mapping it all out for you. So they would say in 20 years, you would be paid off this loan, but it increases at this rate every 2 years. Next is called an extended repayment plan. It's basically similar to the standard repayment plan, except for it's 25 years instead of 10 years. So it's only for it's a fixed amount, and you can also have it on a graduate repayment plan. But basically what it says is this is how much you pay every month to pay it off in 10 years. The only thing is on the right, you'll see information that I put as other information. So on the right, it says that in order to qualify for an extended repayment plan, you have to have at least $30,000 of debt. So meaning of your direct loan or your government loan, because these work for staffers as well too. So of your subsidized, unsubsidized, graduate plus loan, they have to be at least 30,000. So if you have private loans that are 30,000 and your direct loans are only 5,000, you wouldn't qualify because you can't combine the private loans into it. So it's just the government loans. If you wanted to be on the extended repayment plan, you would also contact your servicer to do that. There's no penalty for paying these loans off early, so I'm a strong advocate for getting into the lowest monthly payment plan so that you can really dictate how much, how much you pay each month. Meaning, maybe your monthly repayment is $125 a month, but you can afford to pay $300 a month. So what you do is you keep paying $300, but then COVID happens and a global pandemic happens, and all of a sudden you lose your job, you can still fall back on the 125. You don't have to pay that 300 without being penalized. So you kind of have that relief into it too. The other thing is if you have multiple loans and why you don't want to pay them off even faster is a lot of times people will say, hey, Shannon, I'm paying double my monthly payment, but I feel like I'm not making any indent into my loans. That's because each time you're making a monthly payment, we'll just say that you have 4 different loans and your monthly payment is $400 a month. What it's doing is it's dividing each payment up to each loan. So $100 to this loan, $100 to this one, $100 to this one, and so on and so forth. And it's basically each loan is accruing interest the entire time. So if you paid 800 a month instead of 400, it's now going to just do 200 here, 200 here, 200 here, so on and so forth. If you set up auto pay so you know that you're good and you're paying on time every month, you could set up auto pay for 400. You could still take that extra 400 for the 800 total and put it towards a specific loan. Once you put it towards a specific loan, more money is going towards the principal of this. This is a little bit where it's hard to explain. If I was doing this in person, I usually have a big dry erase board and I'm kind of getting all crazy on a dry erase board here. But basically, it means that all that extra $400 can go towards one specific loan. Once that loan is paid off, there's no more interest on that loan. Then you can kind of focus on the next loan. So it's a typical way to pay down debt where you focus on one and then you kind of move down from there and you kind of adjust from there. So if you're on that low monthly payment, you can kind of dictate where that monthly extra amount goes. So the standard, the graduated and extended repayment plan, you would all contact your servicer to get that set up. That doesn't look at how much income you make. It just kind of looks at, your qualifications are pretty simple and pretty standard for that. The next four are what we call income driven repayment plans. Those say that I want relief to those three and I want other options. So in order to qualify for any of these bottom four income driven repayment plans, it's a debt to income ratio. So your student loan debt has to be greater than your income to qualify, meaning you have to have, let's say you make $50,000 a year, you would have to have at least 60,000 or so of student loan debt in order to qualify. But if your student loan debt was only 10,000, then you wouldn't qualify for an income driven repayment plan. I'm going to go ahead and get started talking about those. First, I want to get started talking about the income contingent repayment plan. I know that's kind of weird because it's out of order and it's at the bottom, but it's at the bottom because it's the one that's probably least used, and that's because it has a higher monthly payment plan, but I'll explain why. So an income-driven repayment plan, like I said, is a debt-to-income ratio, but it's basically determined by what we call discretionary income. And this is a really cool mathematical equation. By no means write it down, but it basically takes the number in household over 150% of the poverty level of the state you live in to determine the percent that's discretionary that you repay. The reason I say it like that is because a lot of people will say, I make $50,000. Is it based on 50,000? No, it'll take into account if you have children, how many are in your household, are you claiming anybody in your taxes, where do you live? Some states have a higher poverty level than others, and all those kind of things. So it's 20% of that it determines. So it's 20% that you would pay monthly on your discretionary income. It has a forgiveness plan at the end of 25 years. So it says if you pay 20% discretionary income every month and you pay on time, you can get forgiveness at the end of 25 years. Notice I didn't say public service loan forgiveness. I just said forgiveness. And I didn't say where you worked. I just said, and I didn't even say if you worked. It just says if you pay this minimum payment, you can get forgiveness at the end of 25 years. Public service loan forgiveness is something else, and I'll get into that in a little bit. But I'm going to separate this on purpose because I often meet with students who say, well, I'm on the public service loan forgiveness repayment plan. No, you're on an income contingent repayment plan, but public service loan forgiveness is a separate benefit that you have. So going back to the income contingent repayment plan, it has a 25-year forgiveness. However, at the end of 25 years, you would pay tax on how much is forgiven, meaning that year you filed taxes 25 years from now, you would have to report the amount of money forgiven on your taxes as basically AGI or adjusted gross income, which can be kind of difficult because you didn't actually earn all that money. This is where people usually say, well, how much do I pay for tax in 25 years? There's no way for you or I to determine that. The reason that is because I don't know tax brackets in 25 years. Will you have children? What will your deductions look like? I don't know necessarily, but what I'm doing is I'm telling you 25 years in advance so you could save money, you could invest it, you could grow it, and kind of prepare for that tax in 25 years. Um, there's a little caveat to this too with income contingent. Parent plus loans do not qualify for income driven repayment plans, and they can only qualify for an income contingent repayment plan that would be income driven if that parent has, I'm about to sneeze, sorry, if that parent has student loan debt themselves. So if you are a parent who has parent plus loan, but you don't have any other student loan debt, you don't qualify for any of the income driven repayment plans. If you're a parent that has a parent plus loan and you have loans from when you were an undergrad that you're still paying off, or maybe you were in grad school and you're still paying off your graduate plus loan, you can consolidate the parent plus loan with the graduate plus loan, and then you can apply for income contingent repayment on all of the loans together. That's a really awesome opportunity for people that maybe have a lot of debt between their own and the ones they took out for their son or daughter that could definitely be beneficial to as well. However, like I said, the 20% one is not used as much necessarily. The next is what's called the income-based repayment, and that's the one that's more commonly used. So income-based repayment is basically 10% discretionary income, and it has forgiveness at the end of 25 years. So the biggest difference is it's 5% lower. So it's bolded because they recently came out with a kind of a caveat change to income-based repayment, which I don't really like because it just offers more confusion for people. But you might have people hear people talk about it as the new income-based repayment or the revised income-based repayment. So I'll talk about it a little bit here, but just know that basically it's essentially pay as you earn. It's just they gave it a different kind of idea. So the income-based repayment, the new one, is a 10% discretionary income, but it's only for borrowers that are new after July 1st, 2014, which essentially means pay as you earn. It has a forgiveness at the end of 20 years if you are a new borrower, which is essentially pay as you earn. Really, the goal is of that one, new one, is to say there were a lot of people that were saying, I had loans a long time ago and I paid them off. And you'll see here in pay as you earn, I'll get into that in a second. But in order to qualify for pay as you earn, you see on the right there, it says you have to be new borrow after October 1st, 2007. So we might have people who borrowed loans in 2006, but already paid them off. So then they borrowed a loan again in 2008. And so they're like, well, that's not fair. I want to qualify for pay as you earn, but they wouldn't. What they're trying to do is say, fine, if you paid off your loans in 2006 and then your new borrow after July 1st, 2014, and you borrowed again July 1st, 2014, you might qualify for a just remodified version of income-based repayment. Probably clear as mud, but basically that's where the idea comes from. But for the most part, income-based repayment or pay as you earn is where I often encourage students to go, and I'll explain why in a little bit. But know that basically that's 15% discretionary income, 25 years repayment. The other one that is called pay as you earn. So pay as you earn is the one that most of you on this call will look at doing. And like I said, you have to be a new borrow after October 1st, 2007. So if you're just now graduating undergrad and you only just taken undergrad in the last 4 years, and this is all the loans you borrowed, you most likely are direct loans and you most likely qualify for pay as you earn. That one has 10 years discretionary income. It has 20 years forgiveness, no matter if you have undergrad or grad loans. At the end of 20 years, you would then pay tax on how much is forgiven, but there is that forgiveness at the end of 20 years. The other thing to say too is pay as you earn, income-based repayment, income contingent. Do recognize how you file taxes, meaning when it comes to filing taxes, you can file two ways. You can be married filing separately, or you can be married filing jointly in the eyes of the IRS. If you are married filing jointly, any of these pay as you earn, income-based repayment, income contingent if you're married filing jointly, it will look at your spouse's income because you filed jointly to determine your monthly payment. If you file separately, it will not look at your spouse's income to determine your monthly payment. This is when I tell people I'm not a CPA, so I don't know you're gaining or losing financially by filing separately on your taxes. But what I usually hear from students is it's worth it for the amount of money you're saving to forego things like a tax refund for filing separately. So there are a lot of people who might be wanting to do pay as you earn and choose to file separately on their taxes to help keep that monthly payment as low as they possibly can. You can also change how you file year to year. So there's no reason why you file separately until your loans are forgiven, and then you can go back to filing jointly. So now I'm going to talk about revised pay as you earn. So they came out with pay as you earn, and then they got really clever in the name. They came out with revised pay as you earn. So revised pay as you earn basically heard a lot of people saying like, I want to have that low 10% discretionary income, but I borrowed loans a long time ago. So they came out with, okay, fine, you can have the 10% discretionary income, but we're going to do 20 years forgiveness for undergrad loans, 25 years forgiveness for graduate loans. But if you see on the right, it does say here both spouses' income. So they saw that people were filing separately on their taxes, and they said, even if you file separately on your taxes, revised pay as you earn, we are still going to ask for your spouse's information and your spouse's taxes as well. So revised pay as you earn is really the only one of the repayment options that you cannot file separately on your taxes and include it as a separate type of income to help lower the monthly payment. So really, that's why pay as you earn and income-based repayment are the two that I tell students to go for, depending upon when they first borrowed loans. And that's just because those are the lowest ones. And even though income-based repayment might be 5% more that you pay every month, you're still paying a lot less for the opportunity to file separately on your taxes. Okay, so next I'm going to go into how you officially apply for an income-driven repayment plan. But does anybody maybe want to type in any questions? Usually there's a lot of questions centered around here at this point. Are we good, Clarissa?
No questions yet.
Okay. Oh, okay. So next are applying for the income-driven repayment plan. So the income-driven repayment plans are created based on the borrower's income and family size, and that's the discretionary income that we talked about. Here are all the different ones that we talked about on the previous slide as well. And as low the monthly payments may be low, the borrower will pay more interest over time. So keep in mind, yeah, I'm accruing so much interest because I'm paying so little. But remember what I said previously, you can dictate how much you pay. There is absolutely no penalty in paying these loans off early. So you could be, on a pay as you earn monthly payment, and you can still pay $500 a month and pay them off way sooner than 20 years. That's no problem. You won't be penalized for that. You just won't have forgiveness because you paid them off before that. So when you do your when you do your pay as you earn or your income driven repayment plan, an anniversary date is going to be very important. So you sign up for the income driven repayment plans through studentloans.gov. And what it's going to do, it's going to ask for your tax information, similar to when you filed your FAFSA. It has an IRS data retrieval tool the same way. So it links to the IRS, it will pull in your taxes, and that's what will determine your monthly repayment for that year. So meaning if you just graduated, where are we, August? We're gonna say you're graduating this summer. So if you graduate this summer, August 2020, you then have your 6-month grace period. So your grace period ends in February of 2021. You want to apply for the income driven repayment plan about 2 months before your grace period ends. And the reason you do it 2 months before your grace period ends is because, like I tell people all the time, this is the government. They do not move fast. You want to make sure that you're doing this in plenty of time so that you're not then delayed or have to make a standard 10-year repayment or a large payment that you don't have to make. You want to do this sooner rather than later. So if you did it in December, it's going to ask for your most recent taxes. Well, December of 2020 isn't 20, the year 2020 isn't over yet. So it's going to be based off 2019 taxes. So that means when you go into repayment, your grace period will end in February. Your first monthly payment would be due in March, right? Because you're going to get the bill in February. It's due 30 days after. So your first bill will become March 2021. And it's going to be based off 2019 income because that was your most recent taxes, but you were in school the whole year. So all you had was maybe a work study job, then you made less than 5,000. So your first year of pay as you earn might be $0 a month. So that means from March 2021 to March 2022, you were paying $0 a month. Then what will happen is you have what's called an anniversary date, which is 1 year after your first monthly payment. So if your first monthly payment was due in March 2021, then by every March, you have to be doing what's called the recertification for your income driven repayment plan. So you're not reapplying for the income driven repayment plan, you're recertifying because, right, your taxes changed, your income possibly went up. So they want to see that reflection. So that means, again, 2 months prior, so around December of 20, where are we at? December 2021 is when you'll do your recertification. Now that's going to be based on 2020 tax year, and you were in school until August, and your first job didn't start until September. So maybe your first job is making 40,000 a year, but you were only working for 4 months of 2020. So maybe your income that year is only like 15,000 AGI. So that means from March of where we at? March 2020 to March 2023. It's based off that 2020 taxes, and it's based off that 15,000. So maybe your monthly payment is only $50 a month. And the point is, I'm trying to get you to see that it's called pay as you earn because you pay more as you earn more. Meaning you will submit your most recent taxes, and that first year will be the lowest. The second year will be higher. It really won't be to that third year of pay as you earn that'll be based off your first full year post graduation of 2021 first full year of working. Now, a lot of people are like, that's amazing. I mean, that first year, I don't have to pay anything. Well, this is where it really offers you an opportunity to invest money or to save money, meaning you can then say to yourself, well, I don't have to pay anything this year, but I could afford $400 a month. So you're taking $400 a month that you're maybe paying yourself in a savings account. So when your payment does jump up to $400 a month, many years from now, it's not a big shock to your budget to say, I have to pay that much more because you've been saving and preparing this entire time so that you can then, focus on that. Another opportunity for the $0 a month payment, if you have direct loans and you've set up pay as you earn, but you also have private loan debt you want to get rid of, you can take advantage of the $0 a month payment with the direct loans and force all of your monthly money you have towards your private loans to try to pay your private loans off as fast as you possibly can. Because the private loans, like I said, don't have any income differing payment plans and there's no forgiveness option for them as well. So again, it's not that you would have to reapply every year, you just have to do your recertification every year. Let's say that you completely forgot. Life happened and you forgot to do your recertification. You will know because that first bill will come and all of a sudden it will go from 50 a month to $1,000 a month because it'll be based on your 10-year standard repayment. And then you'll say, what happened? You will then have to reapply all over again for pay as you earn. There's multiple reasons you don't want to do that. One, I'm going to talk about the caps in a second, but I'll get that. That's bad order. We'll get to the caps in a second. One is we don't know what's going to happen with these repayment plans, right? The presidential could come in and a new president could say that we now no longer want to have all four income driven repayment plans. We just want one. It didn't pass, but Trump's one was 12% discretionary income and he had a 30 year forgiveness plan. So if you were on 10% with pay as you earn in 20 years, and then you forgot to do your anniversary date, then you want to reapply, you might not have pay as you earn as an option anymore. That didn't pass, so that's not a thing right now, but it's hard to say what 10 years from now will bring. So you really want to get on that habit of making sure you don't miss your anniversary date. Another thing is once you sign up for public service loan forgiveness, it could kind of mess up your payments towards public service loan forgiveness. So you want to make sure you're keeping track that way too. And the other reason is the cap. So I mentioned that before. So cap is basically how much you would have paid on a 10-year standard repayment when you went into the income driven repayment plan. So I went in today when I graduated and my interest and my principal combined was a total of $80,000 and my 10-year standard repayment was, I don't know, we'll throw something out to like $100 a month. So we'll just say, no, that's a bad one, it was 80,000, but either way, we'll just say $500 a month. So we say this is how much you would pay every month at $500 on a 10-year standard repayment. Well, remember, pay as you earn was 0 and then it was 50. So if you never missed your anniversary date, you would never pay more than that cap. So if that you made like $200,000 a year, you would never pay more than that $500 a month cap amount. Every time you miss your anniversary date, you get a new cap because you are reapplying. So every time you reapply, every time you change your income driven repayment plan in general, like let's say you were on income based, but you really want to be on pay as you earn, every time you jump around, you have to reapply, which then combines your income and your interest and your principal, and you would get a new cap on your monthly repayment amount. So you definitely want to do that because you don't want to increase your cap because your interest is accruing that entire time, which could definitely increase your cap. So that's, I kind of talked about the cap payments, compounded with the principal and the interest for the recertification and the forgiveness ones too. Like I said, you want to do all of the applying for the income driven repayment plans through studentloans.gov. And this is where I say it's extremely important to remember to file your taxes so you can use your taxes on that. You really only need to use your pay stub to show your income if you have a loss of income. So let's say that your income of 2019 was higher, but in 2020 you lost your job due to COVID, then you might want to submit your pay stubs or loss of job income to reduce your income driven repayment plans because you're saying I can't afford what I pay what income off 2019. You do not need to do anything if your income went up. The reason you don't need to do anything if your income went up is because they will see that when you file taxes the next year. So you'll see that they have a message that says, we only need to know if your income changed if it went down. Because if it went up when you file taxes the next year, then your pay as you earn monthly payment will go up that year. It's really only if your income went down or you lost your job because of that you want to then submit pay stubs instead. Okay. So are we good, Clarissa? Any questions? Okay. So next, I'm going to talk about public service loan forgiveness. So it's definitely a lot to read here. I will say this is a lot more on a PowerPoint slide than I am even comfortable doing. However, I really want people to be able to use this PowerPoint slide without me being here. So I wanted to put all the information I possibly could. Public service loan forgiveness, like I said, those are the income-driven repayment plans that you've signed up for no matter where you work, whether you work at a for-profit, a nonprofit, whether you work or not, it has forgiveness at the end of 20 or 25 years. Public service loan forgiveness is a program that was created to help students that were working in a nonprofit setting. It's not really good when people call it the Obama forgiveness plan, for example, because it actually was a bipartisan program forgiveness that started when Bush was in administration. It just came into fruition when Obama was starting to be in administration. So I like to people to just focus on the fact that it's called public service loan forgiveness. So public service loan forgiveness says if you work in a nonprofit, a U.S. federal government, state, local, tribal government, and you make qualifying repayments, and any of the qualifying repayments would be one of the income-driven repayment plans. Standard, graduated, extended do not qualify. Only the income-driven repayment plans do. So if you work in a nonprofit and you make on-time qualifying repayments under the income-driven repayment plans, you can get forgiveness at the end of 10 years, and that is not taxed. So remember I said pay as you earn could be 20 years and it is taxed. Public service loan forgiveness is 10 years and not taxed, which is really important because that could save a lot of people money if they don't have to pay tax on how much is forgiven. You see where it says 120 payments? The reason I say that is because think about it as one payment a month, 12 months a year times 10 is 120 payments, meaning it's not consecutive. So you could work at a nonprofit, you could take a leave to have a baby or switch jobs, you went to a for-profit, you can come back to it and you can start accruing those monthly payments again. So you can have just 120 payments overall is really the important way to look at it. The other thing I want people to be aware of too is it's not necessarily 120 payments and then you lift your foot off the pedal and you say, I'm done. I paid my 120. I'm good. You, at the end of 120, have to still apply for forgiveness and wait for your servicer to say you are now officially forgiven. So you might end up making 121 or 122 payments because you still legally have to make a payment until you officially see forgiveness. So it's 120 payments to physically be able to apply, and then you have to wait for them to officially say you're forgiven. Only payments made after October 1st, 2007 count. And again, only direct loans count. So if you didn't consolidate your loans, you would have needed to, and then any payments after that would have to count. The servicer is Fed loans. So that's important because when you first apply for public service loan forgiveness, you're going to fill out what's called this employment certification form, and a link to it is at the bottom. The employment certification form is you certifying that you work in a nonprofit setting. You're going to give it to the human resources of the place that you work, and they're going to say, yes, Shannon works there, and you have to be full-time employee too to qualify for public service loan forgiveness. So yes, Shannon works at us. We're a nonprofit, and she does work full-time. And you're going to take that certification form, and I believe it's the 4th page of the form is Fed loans information. You're going to mail it to them. So even if Nelnet, for example, is your servicer, you're still going to send it to Fed Loans. They will then approve your place of employment for public service loan forgiveness, and they're going to transfer your loan portfolio from Fed Loans to them, meaning it'll take about 60 to 90 days to do everything. However, how it's going to work is now when you log into Nelnet, you'll see that you don't owe Nelnet anything. But when you create an account with Fed Loans, you'll see that all of your loans now are with Fed Loans. You will never lose Fed Loans as your servicer because they have been chosen by the Department of Education to be the sole servicer for public service loan forgiveness. But remember, I said it's not consecutive. So even if you don't do an employment certification form, even if you're not working in a nonprofit, you'll never be kicked out of Fed Loans being your servicer. That next year that you maybe do another employment certification form, I'll get into why you need to do it every year, but that next year, you don't have to mail it into them. You can just log into your account with Fed Loans. You can click on, I believe it's upload forms, and you can even upload the employment certification form directly to your account really easily online. So what loans qualify for public service loan forgiveness? Like we said, any loans that are part of the direct loan program qualify for public service loan forgiveness. Which loans do not? Those are the family federal education loans, Perkins loans, or any private loans. So the employment certification form, like I said, you want to fill that out every year. It's not a requirement to fill it out every year, but the reason you want to is because you technically don't have to until the end of 10 years, but we don't know what's going to happen with public service loan forgiveness. It's always a question every year. We always get different political backgrounds come in and want to get rid of the program, and then it falls into the wayside and it's not a thing anymore. So, but we really don't know. And we think that employment certification form will hopefully be the grandfathered in system, which says if you get rid of the program, if anybody has done at least one employment certification form, you can go ahead and finish up. But if you're just now starting, I'm sorry, this program doesn't exist anymore. So you definitely want to just get into it in the beginning. Also, you don't have to do it until, like I said, the end of 10 years, but you'd have to go back every year that you place that you worked in the last 10 years. You'd have to have them fill out employment certification form, which could be really awkward. Let's say you left that job on bad terms, for example. You have to track down the HR and say, hey, can you fill this out for me? What if the company closed? Then you have to try to figure out how to get the employment certification form filled out for a closed company. So it's a lot easier to fill it out if you're physically working at the company right then and there. Another thing is too, FedLoans does a really good job of helping you track how close you're getting to 120. Everything is though retroactivated, meaning when you first apply for employment certification form, you officially will be Fed loans and you officially will be doing pay as you earn, but you'll be paying like, let's just say $0 a month, but you'll be seeing that it says zero payments made towards 120. And you say, well, that's weird. I'm making my monthly payments, but why is it not counting towards anything? You really don't get started to get credit for it until you turn in the next employment certification form. So next year, when you do another one, it's going to say, okay, of the previous year, what in the month of January did Shannon pay on time? Yep. Did she work full time in the nonprofit? Yep. Okay, she gets credit for that. And it makes it so that people aren't turning in the form and then quitting their job the next day. So the idea is that it's going to look back. And so all of a sudden, the next form will now say 12 payments made towards 120. And the next year it'll say 24 payments made towards 120. But either way, FedLoans does a great job helping you keep track. A last reason why you want to do it every year is because, like I said, at the end of 10 years, you'd have to go back and they're checking you every year you're doing it. So at the end of 10 years, if you have to wait and then have the Fed loans do the certification and check 10 years worth, you're probably going to have to wait that much longer for them to verify 10 years of employment. If they've been keeping track every year, that last year, they only have to go back 1 year if you've been doing it every year. So that could be a faster time for them to tell you that you get forgiveness. Maybe it's only a month or two. But if you wait to the end, they have to go back 10 years to certify your forgiveness, which could be 5, 6 months until they can approve you. And in that time, you still have to be making payments. And so the question is then, well, when do I do my employment certification form? Do it the same time you do your annual recertification for pay as you earn or whichever repayment plan you have. Why not just do them both at the same time? That way you make sure you're keeping track every year and you're doing both of them at the same time. So again, your repayment option is pay as you earn. A benefit you have of being a nonprofit is public service loan forgiveness. So if you're in pay as you earn and this month you weren't working because you took time off to have a baby, you're still making your monthly payment under pay as you earn, but you don't count towards public service loan forgiveness. It's counting to a forgiveness. It's just counting towards the 20 years instead of the 10 years. So you might end up, physically making payments for 12 years to see forgiveness at the end of 10. It just kind of depends on your own situation. Krista, do we have any questions on that so far?
We have no questions. We do have the questions that we had been sent before. I don't know if you want to address them now or at the end.
Let me do them at the end because maybe I might answer them a little bit here. Okay, so the next forgiveness option is what we call teacher loan forgiveness. So, who is considered to be a teacher for teacher loan forgiveness? It's an individual who provides direct classroom teaching or classroom type teaching in a non-classroom setting. Special education teachers are considered to be teachers as well. How much loans is forgiven for a teacher? Depending upon the subject, it could be up to 17,500 for teachers in what we call the STEM field. So math, science, technology, special education, those kind of things would be up to 17,500. and it could be up to 5,000 for teachers in one of the other non subjects that could be like history, social studies, reading. Those could be different ones too. To be eligible for the program, you must have at least 5 years of consecutive academic year teaching full time. So remember, public service loan forgiveness, it wasn't consecutive. Teacher loan forgiveness, it is consecutive. You also have to be employed at a low income school. Um, and it doesn't necessarily have to be poverty, just more low income school. Loans seeking forgiveness must be made before the end of the 5 year academic of the teaching service and must have no outstanding balance obtained on a direct loan or FEL loan as of October 1st, 2000, or sorry, October 1st, 1998. In order to apply for it, you would just fill out this form at the end of the 5 consecutive years. And then it would also, the other thing I want you to know, it's not just for direct loans. This is also for FFEL loans, direct loans. It's only for unsub and sub loans. It is not for any graduate or parent plus loans. And it also is not for any Perkins loans. So a lot of people ask, can I do teacher loan forgiveness and public service loan forgiveness at the same time? Sure, there's no harm in doing both of them too, and just kind of getting all the loans that you can for max amount forgiven. Okay, so next is forbearance. So forbearance is
One question. Sorry.
yeah.
It said they asked if I have been working for an eligible nonprofit for PSLF for 2 years but did not complete the employment certification form. If I complete the form now, will my previous 2 years of payment still count towards my 120 payments?
Yep, good question. So remember I said it's retroactivated, so I would definitely recommend filling out the employment certification form now so you can make sure you get credit for those two years you've already done, and so you can start getting on your habit of doing it every year. Like I said, it's not that you have to do it every year, it's just there's so many pros to doing it, you might as well. But yes, absolutely, those 2 years, as long as they are direct loans that you have, those 2 years would qualify for the 120 payments that you have. So you can at least know that you have roughly, what is that, 24 months. So 24 payments under your belt that way. Okay. So next is forbearance. So I like this graphic here because it kind of explains forbearance pretty well. It's basically you keep making payments and then all of a sudden some hardship happens and now you have to forbear your loans, which is the yellow. And so you're not making payments anymore, but interest is still accruing. So we'll talk a little bit more about what forbearance is. It allows borrowers to stop making their monthly student payment or temporary stop making or make smaller payments temporary. They work with their servicer to ask for the temporary forbearance of transitioning between undergrad and grad. So if you're on this call, you're finishing up undergrad right now, and you don't start grad school until like next fall, we'll say, of 2021, you might want to do temporary forbearance on your loans and let the servicer know, I'm going to school next fall, so I really don't want to make payments right now. But just be aware, you don't legally have to make payments, but your interest is still accruing. So you might still want to make some payments if you can, maybe on some of your subsidized loans before they accrue interest after the grace period. It just kind of depends, but you might want to still make payments on those type things in the meantime. You can also get up to 1 year of financial hardship forbearance. So if you are just like, I don't know what I'm going to do, I lost my job, you can just call your servicer and they'll give you up to 1 year of forbearance, which means you don't have to make any payments at all. But again, interest is still accruing on that too. Uh, Borrowers contact your servicer for forbearance. I do want to make a point that forbearance does not qualify for public service loan forgiveness. You have to be in a qualifying repayment for public service loan forgiveness. So if you have financial hardship and you can't afford to make your payment, you really should contact your servicer to see if you can submit a pay stub to reduce your pay as you earn payment to make it so that you can qualify for public service loan forgiveness. If you ask your servicer to do forbearance, then all of that time, that's not going to count towards anything, any forgiveness, whether that's the 20-year forgiveness, whether that's the 10-year forgiveness. Forbearance is just basically like freezing time, essentially. So I'm not really an advocate of doing forbearance, but I want people to know that it is an option when they feel like they have no option. Because if you truly can't make a payment, then you should qualify for $0 a month payment, which could count towards public service loan forgiveness or some sort of forgiveness option. So you shouldn't necessarily do forbearance. Even people that do AmeriCorps or Teach for America, they automatically get forbearance if they want. I sometimes recommend to them because they are working full time in a nonprofit, not making that much money. I recommend to them that they don't do forbearance, because you could benefit from Teach for America or AmeriCorps and get benefit for public service loan forgiveness, but not do forbearance. Like I said, forbearance typically does not qualify for public service loan forgiveness. The first time I have seen working in financial aid was when that changed due to COVID. So I think one of the questions somebody had too was, how has any of this changed due to the COVID situation when it comes to student loans? For the most part, all of these repayment plan options are still the same. The only thing that really changed was that interest isn't accruing right now, and any forbearance that people were given because of the fact that they lost their income. So if you were given forbearance starting in March because of income, that could still count towards public service loan forgiveness, and it still could count towards your forgiveness overall if you went into forbearance because of COVID. I will say though, this changes all of the time, but that makes sense because the government is changing the rules on COVID all of the time as well. You can definitely contact your servicer to make sure that your time is counted towards public service loan forgiveness if you're in forbearance due to COVID. But I also recommend checking out that website because they have been updating it really good on live updates about any changes that come with the coronavirus when it comes to the student loans. But just know that if you're not having to make any payments, not making a payment does qualify for public service loan forgiveness under COVID. Even if you make a $0 a month payment under pay as you earn, that qualifies for public service loan forgiveness as well. So other programs that might benefit you that are similar forgiveness programs that are not necessarily directly from the Department of Education, but they do exist, would be like the National Health Service Corps. So if you are a medical student, or maybe you're in nursing, or maybe you're a master's of social work student, you might qualify for applying for National Health Service Corps. National Health Service Corps is basically an application that you fill out every year, and you can contact them on their website directly. If you are approved for it, they put you into an underserved area to work for a certain amount of time anywhere in the country. So they say if you work for us, let's say for 2 years, we are going to give you up to $50,000 for full-time work. They then pay that to you. The only thing I want you to know is you do pay tax because it's actual payment to you, so that you would have to pay tax on that 50,000. So we'll just roughly round down and say maybe it's 40,000 that you actually get. You could then save the 40,000 and still use that to pay towards your public service loan forgiveness, towards your monthly payments, or you could use it to pay towards your private loans. It's just intended to go towards your student loans as a whole. It just doesn't pay directly to the Department of Education. It goes directly to you. Similar to the National Health Service Corps, there is the Virginia Health Service Corps. It's just different. It just means you would work in an underserved area in the state of Virginia versus anywhere in the U.S. It is a competitive program, though, so you do have to apply and get accepted into the program first to get the loan repayment. The other thing are military benefits that might have forgiveness options. So I did link there. A lot of them you probably already know about if you work in the military currently. However, if you just get started, there are some benefits for working in the military and getting loan forgiveness option because of that as well. So that kind of concludes everything. Like I said, I'm a presenter, Shannon Osborne. I'm the Assistant Director for Financial Wellbeing, and Clarissa was the moderator. We are really excited about creating financial well-being for Mason, and we did come up with a website that we just went live with, I think, within the last week or so. So there's a link to there, and that's where we'll have this recording and the PowerPoint presentation in our email. I did want to point out our awesome little marketing pig here, that our next one we're planning on having for episode 2 would be October 14th, this same time at 1 o'clock. We're going to do creating a budget and managing credit. So we're going to work on budget and credit. We are working on trying to establish the full year's worth. We're just kind of working through the ins and outs of that. But we imagine it being anywhere from understanding your awards to health insurance options. I mean, the sky's the limit when we come to different options with financial well-being. But if you yourself have an idea, we're open to that as well too. I think I'll open the floor to any questions you guys want to type in the Q&A here. And I'll stop sharing. Clarissa, maybe we want to talk about any questions I missed. I do think one of the questions previously was about loans for DACA students. That was kind of more not because of repayment. That's more loans that could possibly be loans that DACA students could borrow from. And that's going to be a presentation for a different time when we talk about different awards. However, there are things that DACA students are truly struggling, like the Student Emergency Assistance Fund, and there's other various options they could have as well, like a private loan with the U.S. cosigner, or all sorts of different options we can walk through with them. So I would definitely encourage, if you're working with a student that fits that category, to email us, and we can definitely work with that student. But we'll talk about that at a different time too.
One question is, what is important to note when selecting a loan provider?
So it's not that you're necessarily selecting the loan provider, right? Because your servicer is assigned to you. The only time you would ever select a loan servicer would be when you consolidate your loans. And I'd recommend picking the servicer you already have. So if you're consolidating a FFEL loan into direct loans, or a Perkins loan into direct loans, and it'll say who you want your servicer to be. If your direct loans are already Nelnet, pick Nelnet. You want everything to be together. So it's not necessarily who you get to choose, but Fed loans would then be who you go to for public service loan forgiveness.
The next question is, how do I know that a, a loan forgiveness program for public servants is legitimate if I have been receiving phone calls?
That's a really good question. So, a lot of times, there are companies that like to benefit and profit off of people. You should never have to pay anybody ever to sign up for public service loan forgiveness, or to sign up for any of your income driven repayment plans. You can do that on your own. I know you can. You can work with your school. We can help you do that. I unfortunately have worked with people who have said they've got given a lot of money to third party scam places, thinking they were signing them up for public service loan forgiveness when in fact they were not. I have not been afraid myself to call them back and say, I know you're a scam. They hang up on me every time, though. I try, but they hang up on me. But anyway, so the point is, if you are questioning, should I give money to somebody to sign me up for public service loan forgiveness? Reach out to your financial aid office, reach out to the financial well-being team here, and we can let you know and kind of help you walk through that, because you should never give money for something you can get for free.
I am an ER nurse and graduated in 2008. Would I qualify for a loan forgiveness program?
Yeah, as long as you've been working that whole time in the nonprofit and they are direct loans, we would want to look to make sure that you do have direct loans. So you'd want to look at studentloans.gov to see, or you can schedule a meeting with us too. We can look it up and see and make sure that you are, but we can walk you through that. And if you've been working since 2008, then you could be pretty close to the forgiveness. And we can walk you through even to how to physically apply if you do meet all the criteria.
The last question, are there any forgiveness loan programs that assist senior citizens to repay their loans?
So it's not necessarily to assist senior citizens. Senior citizens qualify for any of these forgiveness plans themselves. It's not something fun that I like to talk about by any means whatsoever, no matter where you are in life. I just like people to know their protections. These loans are forgiven in death or permanent disability. So if anything ever happens to you, your family is not responsible to repay these loans. So I just want people to be aware of that, especially, young people before they get married might want to explain their spouse to them that, these are my loans. We can file separately in taxes. I can repay them. They don't have to become yours. If anything happens to me, they have forgiveness at the option too. But it's more just knowing that you do have options of forgiveness, whether you work or not. So you could do an income driven repayment plan. You don't have to be working to do an income driven repayment plan, and you could get forgiveness at the end of 20 years or something like that. Is that all?
Those are all the questions we have.
Cool. So it looks like I don't see that you guys have typed in any in the Q&A, but if you do think of any after this, like I said, fwb@gmu.edu is our email address. Feel free to send us an email, or we can set up a time to meet. This is really good because it gives you a really great overview of everything, but sometimes having that one-on-one to say, this is my situation with my loans, can we meet to then talk about my situation, is even better too. Well, thank you guys very much, and I think we'll sign out from here. Bye bye.